Thanks for everyone for coming. I'll give a quick lay of the land really quick, and then we'll jump right into this. But one thing that I want to mention out of the gate here is really stressing the importance of the whole turnkey style access to a wealth building team. Maureen is a great partner to have, and there's lots of business owners. Steve just jumped in here too. There's lots of business owners inside this realm too. So you could add Maureen to your existing team to help people out. I'm a big fan of turnkey real estate, but more importantly, the turnkey access to your entire wealth building team. So again, that is the main intention of this whole webinar series is to give people access. It should not be that difficult to find trusted people and trusted locations. But again, that is why we are here today. And that is what the purpose of this webinar. Quick agenda and flow for everything. So Baggio, as you guys know, is a full-time realtor. He's going to break down some key issues that are happening right now, just kind of generally in real estate. Maureen's going to jump into what she does with Spartan Invest. She is a great turnkey provider, mostly focused in the Alabama space. And then I'm going to use myself as a case study for this webinar and go through some no-shit examples using my numbers of how I combine the strategies of privatized banking with turnkey real estate. So we get a real example of how this will work in real time. But yeah, Baggio, please kick us off. Thanks.
Yeah, appreciate it. Awesome, man. I'll keep this one short and quick. It's kind of both means the same thing, right? So short and quick. From my perspective right now, what I'm seeing a lot, as far as let's just say people finding success from the investing standpoint, and it's kind of what we've talked about in the past couple webinars, but um, easily deployable capital and speed, right? Um, and I think we all kind of have different avenues that we can hit that from. And what I would say too, from a seller's perspective in a lot of markets, especially when I'm talking to folks in different regions of the US, um, the huge swing post-COVID kind of created a shock. And there's just been, I think finally people are coming to the middle ground terms on what's realistic for purchase price for selling a home, buying a home. And sellers took a while to kind of come to terms with maybe that sticker shock of what they're not getting for their home versus, 2, 3 years ago. Um, and then that's where y'all come in and people that can employ, cash offers or hard money offers or any kind of offer of that scenario that is not conventional, that's creative, is really intriguing for sellers these days because honestly, a lot of times the conventional route, the conventional buyer, um, I guess is gouging them is kind of just if they have more leverage, at least here in this Phoenix market and a couple other markets that I know of. So, um, you know, 2 years ago, sellers were just very unrealistic. And even with investors I was working with, that was the struggle, was kind of meeting them in the middle, trying to find, and you're having to educate and re-educate people that are trying to sell their house, right? So um, now we're seeing that come back around, and y'all are in a perfect position. I feel like, especially in Arizona, I'd say I've heard of Texas being similar, some Midwest regions, depending on where you're on the South as well. There's a lot of opportunity now because people are finally being able to just ready to negotiate, I guess would be the best way to put it, right? They're not looking to, they know they don't have the hottest commodity and they're looking for really any avenue, any way to sell. So, um, you know, that's all I really have today. I don't know if y'all have any questions on that, but we can go forward from there.
Yeah, let's do it. Let's jump right into Maureen's piece on Spartan Invest.
Awesome, guys. Well, first of all, thank you, Austin, for putting this together. Baggio, for kicking it off. I appreciate it. And for the rest of you guys that have joined us tonight, appreciate the investment of your time in learning a little about something new. So, or at least turnkey in Alabama. So, just a little background. So, 20 years of experience in the turnkey space. I can't even believe I'm saying that actually. But I came from the W-2 world. 15 years there, pharmaceutical sales, medical device sales. I traded my time for money. Didn't realize, I didn't find a way to get off of what do they call it, out of the rat race, right? And so had to figure out a way to really provide a quality of life for myself and my 3 kids, and living in Southern California. So yeah, I had to figure out a way pretty quickly. Once I call it divorce the husband. You're welcome. You can borrow that term. But once I got rid of the husband, then it was okay. Let me figure out how I'm going to be able to maintain the quality of life, grow my quality of life, and live a financially worry-free life. And just quick backstory, if you're like me, when I started learning about real estate, there was no podcast, there was no webinars, there was no blogs. It was read books or go to seminars. So I became a seminar junkie. I went to all the free stuff, right? Then I started investing in my education, which I'm sure I've invested well over $100,000 just between the education and the masterminds. I've done the Tony Robbins thing, the Millionaire Next Door. I've done it. I've done a lot. But I figured I believed in myself, and you got to be educated. And so I spent the time, the hours, I missed the parties, on the weekend with my friends so that I could learn this for myself. And now I have the privilege of being able, and honor, I would say, to be able to teach others what it is that turnkey real estate can do. So with that, I will launch off and say, Spartan Invest, we've been in business 12 years, put over 2,300 doors under management. We've got a team of 93, revenue over 60 million. So we're not a small company, but we're not necessarily huge either. Long-term goal for Spartan is really just help individual investors build a real estate portfolio, one property at a time, in a turnkey fashion, meaning we do all the heavy lifting. We buy the distressed asset. We renovate it. We place a qualified resident in the property. We do the ongoing management. In all the major cities in Alabama, with the exception of Montgomery, we manage there, but we don't flip there. Chattanooga, Tennessee, and Northern Georgia. And we have our sights on expanding into future markets, which include Kentucky or the Carolinas. Not sure which one we're going into next. But if you guys anyone is aware of one of my favorite reports, it's called the U-Haul migration or in-net migration trend report. You can go back as many years as you want. I've been tracking this for 8 years. And why do I track it? Because I'm looking for where people are moving to. U-Haul measures one way, right? So they're measuring where are their trucks going? And that way we can see where the population is growing. So I will say, finally, after 8 years, Alabama is now in the top 10. So we've been, Alabama's really been I would say like from 22 to 18, ranked out of 50 states. And just in 2025, it pushed up to number 9. Why? Right? And if you just look at the top 10, it's always Texas, Tennessee, Florida. They're always jockeying for 1, 2, and 3. Then you've got the Carolinas, Georgia, now Alabama. And what that shows you is people are moving south. They're moving to the southeast. Why? Lots of jobs, low property taxes, lower barrier of entry. If you want to relocate and buy a brand new home, you can for probably a lot less than your backyard, especially in mine. I think you can't really touch anything under $1 million here in San Diego now at this point. And so a lot of people are migrating to the southeast. It's a really great way to just track where people are going. So what Spartan really does is we do 2 things. Number one is we help investors build a real estate portfolio. And then we help them either get into renovated homes or build to rent properties. So we do new construction as well. We started a new construction company in 2020. Not the best time, by the way. If you all knew what was going on in 2020, there was the supply chain disruption. And so we had 15 properties. Brand new homes, couldn't close them, couldn't find cabinets anywhere for months, tied up our line of credit. So we've learned to now have a warehouse to store our supplies so that if that ever happens again, we're not stuck in that situation. I think what's really important, for this call, and I'm happy to take questions, really, I love a more interaction versus me just talking to a screen and looking at myself. That's really not that fun. But what my purpose really here is just to kind of introduce you guys to what Turnkey is, how we do it, how we differentiate ourselves, And so I will say that, and I don't know if anyone has investment properties already, or if you're just thinking about it, but I will, if I can give you one piece of sound advice, it would be this. The most important decision you will ever make in investing in a rental property, it's not the market, it's not the street, it's not the house, right? They are important, but the most important is who you hire to be good stewards of your capital, aka your property management company. So where the real differentiation happens, in my opinion, in 20 years, and I know the I would say at least there's only really the top, I would say about top five turnkey companies in the US that run it like a business, very similar to us, is the biggest differentiator is the pay for performance business model, right? And I don't know if you guys have heard the horror stories about bad property management companies, they're out there. And it is, in my humble opinion, that the reason you have not so stellar property management companies is because usually they're hiring, I call them 9-to-5ers. They're paying them low wages. And so you're getting low performance, low results. But we took a different approach when we started Spartan, my partners and I. We all came from corporate backgrounds. We all had KPIs, we had metrics that we were being measured against. And so we implemented that same strategy, or business practice, I should say, in Spartan. So what does that mean? Our pay for performance is we have aligned our team members' goals or metrics that we measure every 5 business days with the outcomes that we want for our investors. So for example, we will bonus, we pay healthy quarterly bonuses, but my team, in my property management side, they've got to deliver 95% or higher occupancy rate, a 2% or lower eviction rate. My turnover team has got to turn the property in 3 weeks or less, right? Because time is money for you and me, right? How do we all get paid? We all get paid when we have an occupied property paying rent. When that property is occupied and paying rent, you're getting your cash flow, we're getting our property management fee. When the property is vacant, you're not making any money, nor are we. So our goals are aligned. We actually want our investors to succeed because we all win together that way. That sounds so cliche, but it's really just how we're set up. So that pay for performance is really, really important. I think some things that, and by the way, we measure those every 5 business days. So we're tracking those. That's only a few of the metrics. There are a lot of metrics. We're a very metrics-driven company because if you're not measuring it, then you do not know if you're hemorrhaging or losing money for yourself or for others. So lots and lots of metrics that I could share with you offline or on this call. Happy to answer them. So I think also just maybe just a little some price points. I think that might be helpful. I'm not sure where all of you guys are based, but hopefully these numbers impress you. We operate in B-class neighborhoods, working class neighborhoods, very safe, very clean, near lots of industries and stable and diverse local economies, always near large employers, because renters like to live near where they work. So we are strategically in markets, that are very in close proximity to anchor employers, such as Amazon distribution, Amazon fulfillment, Dollar General, a lot of warehousing, Dollar General, Lowe's distribution, etc. And price points are from about 125 to about 200,000 on our rehabbed houses, and then our new construction is 270 to 290. So that's laughable in my backyard, but it's very doable, and easy to enter, right? Because you're only looking at, call it, I would say 35 to 50,000. And then if you want the new construction, that's probably 70,000 plus to get into that. But very reasonable terms, rates of return on leveraged money. You're looking anywhere from 9 to 12%. On cash, a solid 7 to 9% in there. Cash flows can be anywhere on leverage. You're looking at, I would say, on the low end, like 275, on the higher end, close to 400. Some properties have over 400 a month after all expenses are paid. And then what makes and I will say this, you guys will realize I'm a very transparent person, right? So prior to 2021, Spartan had zero promotions. We had a few warranties, but we had zero promotions, right? What happened in 2021? Interest rates doubled. Now you're looking at 8% to get into an investment property. Cash flow was under $100 a month. It was pitiful, right? So we had to figure out a way to pivot pretty quickly to be able to still provide a quality property value and cash flow in our current markets that we serve. And so we started off with a few, 1 year maintenance guarantee, and we'd waive some fees and things like that. But we got savvy. And in Q3 of 2023, we learned of something called a forward commitment. Forward commitment really it allows home builders, which we are one, to buy down the interest rate, no limit on the number of points we can buy down. What does that translate to you today? It means I can offer a 5.5% interest rate, 30-year fixed, 25% down through neighborhood home loans. That's my conventional lender. And Austin doesn't know this because I haven't told him yet. We are now offering 5.5% on a DSCR, 25% down, 30-year fixed. There's a 3-year prepayment penalty if you refinance on the DSCR. You can title the property in the name of your LLC directly with the DSCR. And the only, there's requirements, the minimum credit score, 680 or higher. They prefer 780, but whatever you got, they can work with. And so those are options that really make the cash flow a lot better, because interest rates right now for an investor is about 7.25 last time I checked. So 5.5 is a real aggressive rate right now. And then wait, there's more. There's whoever came up with that little like commercial thing, it really works because there is more. So we do have a few other things that I think are worthy of mentioning, and then I'll open it up for questions. We have as I know Austin's got to talk to, so I'm gonna keep this short. Sorry, Austin. So besides the reduced interest rate, on our renovated properties, we offer a 1-year rent eviction guarantee. 2 parts to that warranty. The first is if Spartan fails to place a qualified paying resident in your property 30 days post your closing date, Spartan will begin depositing the amount of the rent shown on the pro forma every month until we do, up until a year. Never had to use it. Maybe a month or 2, right? But I've never had to use it for a full year, but it's a way to make investors feel safe in doing business with us. Second part of that warranty is eviction. So if an investor experiences an eviction within the first year of ownership, Spartan will cover the rent during the eviction process. And Atlas, my property management company, which is in-house, that makes us true turnkey. We don't third party that property management house. We're control freaks. We like it in-house. Atlas will cover the attorney's fees and sheriff's set out fees if there is an eviction within the first 12 months. That's for renovated properties only. Then I have what's called the 333 deal. So what is that?
That's a promotion. There's 333. So sorry to inject really quick. So you guys know me and like my superpower being able to really go in depth on things. When I was networking and really researching this turnkey route, this 333 deal has truly not been met yet. So this is really cool. So
thanks for the plug, Austin.
Sorry for the inject. This is
No,
pretty neat. I didn't know you guys were still running it. Last time that we talked, you were talking about potentially ending it, but yeah, please. Thanks.
Yeah, no. So this promotion has been going on since 2023, hence the play on the number 3. So here we are in 26, we're still promoting it, right? Because it's working. So here's how it works, right? So we're offering, so I should start off by saying this. Our standard property management fee is 9%. Okay. The 333 is we will give investors 3% property management fees for 3 years on up to 3 properties and the 3% begins when they close on their second property with us, right? We kind of say within a 12-month period, but honestly, it's been loosey-goosey. So we're looking for volume. You guys are looking for the discount. If it works, we'll keep it going, even if it's past a year. Right? So that when you have the 5.5% interest rate on a fixed mortgage and you combine it with 3% property management fees, if you like the rate of return and cash flows on the pro formas without all of that, you are going to love it even more so when you see those discounts applied. And so that 333, I love it. And we operate in sets of three. So it's not like you're three and done. If you start a second set of three, which is like property number 4 and 5, they would get 3% as well. Right. So it's I see Richard going, oh, okay. I saw the facial reaction. Sorry, Richard, I'm calling you out.
Yeah.
So that's a really big one. Am I missing one? Oh, and then for our new construction, we are offering 0% property management fees for the first year, and we waive the leasing fee. So there's a lot of things now. Now, mind you, I didn't have to say all that prior to 2021. Now I have to say all that all the time. But honestly, it's really worked out. And who knows what's going to actually wind up being a full-on warranty forever. Versus, and maybe we'll convert some of these promotions to, I guess not warranties, but permanent policies. We're looking at that. So well, we're going to keep it going. That's for sure. So there's a lot of opportunities. The rates of return are really exceptional, especially when you start adding the 3%. I get rates of return in easily 12, 13%, just cash on cash, not even including anything else. So it's worthy of taking a look. And hopefully I've hooked you enough to maybe ask some questions. So I'll kind of open it up there and see what anyone's got for me.
Hey, sorry, I have a pressing one. Can you give us a little like market update? Like, what are you seeing for the best markets? I know last time we talked, Tuscaloosa was doing very well. Birmingham seemed to be pretty pocketed, but with your expansion into the Carolinas, perhaps, or some different areas, what are some of the markets that you're most excited about right now, and let's say like in the next few years?
So definitely, I would say I'm a big fan of Northern Alabama. So what does Northern Alabama consist of, right? Your Huntsville, and all the secondary and tertiary markets around Huntsville. If you can just Google what has happened, the happenings in Huntsville, and you'll have pages and pages, right? And we saw this coming because we've been in Huntsville for about 5 years now. We saw when it crossed over, when it became the largest MSA, overtaking Birmingham, which used to be the largest MSA, and it did it. They were projecting it in 5 years. It did it in 3 years. So just explosive growth. So anything in Huntsville proper, and then you're really going to find a lot of interesting opportunities. I call it the spillover effect. So if you can't get into Huntsville proper, because Huntsville, I think, is becoming more of a Nashville. Before anyone knew about it, margins were great. They weren't getting thin. There wasn't a lot of competition. Now that the spotlight's on Huntsville, margins are starting to get squeezed a bit. But the spillover markets, they are exceptional, and they're about within 30-minute drive to downtown Huntsville. So that would include Hartselle, Decatur, Athens, Cullman, Arab, Albertville, places that you're like, where are you talking about, Maureen? But honestly, they are just outside this major city, and they are exceptionally good. Lots and lots of jobs. A lot of manufacturing is done and I'm going to say Europe because I'm going to Europe next month, so it was on my mind in Alabama. And so I'm a big fan of anything in northern Alabama. Now, this Interstate 65, it connects Mexico to Canada, goes directly through Birmingham. That 65, I call it the 65 corridor in between Birmingham and Huntsville. There are some really gems of markets. No name towns, Jasper, Warrior, Kimberly, they're right off the 65. Huge manufacturing plants out there. People want to live there where they work. Anytime I get something in Jasper, the other sales guy, Danny, and I were always fighting who can sell it first, because it's such a good little producing market. So I'm a big fan of anything along that 65 corridor. Like you said, Austin, there's pockets in Birmingham that are doing exceptionally well. Actually, it's the Birmingham has so many zip codes, but one of my favorite zip codes is 35235. Predominantly owner occupied, very close to everything, lots of industry around it, all the amenities are near it. Um, that's what we had one property that came up last Wednesday and was there's four of us now on the sales team. It was sold within seconds of being listed. We were all trying to get our people to buy it. So that was a little bit crazy. And then I'm a big fan of Tuscaloosa. It's the home base there as far as the industry base is mostly education, University of Alabama. A lot of manufacturing, Goodyear, Michelin Tire, Nucor Steel, Westervelt Lumber, just to name a few. There's a lot that's happening there. Lots of private investment capital as well. A lot of commercial stuff going up. A lot of strip malls, not shopping malls, but like small strip malls with designer names going in. So I really like that. Anytime you see that private capital going in there into a market, it's a really good indicator that they've done their research and this is where they're going to put their money. Like if you see motels, hotels, um, pharmacies, popping up, those hoteliers and the CVS, they've done a lot of research on where to place these properties strategically. So we just piggyback off of their hard work and set up nearby where they are. So that's what I would say. Chattanooga is good too. It's got a 10-year growth trajectory that looks exceptionally good. But the price points up there are a little bit higher. They're over 200 usually, just because the acquisition costs are higher up there. So if you're looking to stay under 200,000, then some of the Birmingham markets would serve you really well.
Cool. Awesome. That was a great breakdown.
Excellent. All right, who else has got questions? I know, don't be shy. Bueller.
All right, I guess I'll start.
Okay.
First, I like the name Spartan. So, I'm currently active duty. I've been in the Marine Corps for about 20 years now. So I'll probably be retiring here in about 5. So I'm currently located in Okinawa, Japan. So it's
I've been
about,
there. I've been
yeah,
there before. Very
yeah,
cool. Thank you
it's
for your
nice.
service.
Yeah, it's nice. It's about 9:30 in the morning here on the 27th. So, yeah, I honestly, I've been looking for someone like you for a while. Somebody that could like buy homes that haven't been taken care of, rehab them into a turnkey, nice property, and then rent them out to some solid tenants, all under one roof. It's almost too good to be true, to be honest with you. The numbers are all great. As you were talking, I was actually thinking like, man, I should just walk away from this deal I'm closing on right now in Columbus, Ohio, because I got him for he put it up for 250. I talked him down to about 220, and then I got a 10,000 seller's credit, DSCR 6.5, and but I got 1,000 earnest money, and I've already paid 850 for the inspection. So I don't know if I'm gonna
Yeah.
walk away at this point, but I
I'm not convincing
definitely.
you to. Columbus, Ohio is a good market as well. They're still growing and expanding for sure.
Yeah, it's like a C-class neighborhood, you know. One of the tenants there, I don't even have a copy of the lease. I'm hoping that it doesn't come back as like a Section 8. But I'm all about diving in first and then asking questions later. I don't know why, but it seemed to have worked out for me. So and meeting Austin here, he's linked me up with a few people that are solid, including yourself.
Thank
And
you.
I can't be more appreciative of that. But yeah, the I'm seeing like 25% DSCR, 5.5. So when you said that, the first thing that came to mind is I've been working with these guys on they're called Harmonial AI. So these guys are pretty badass, to be honest with you. Excuse my language, but they're like there's two guys, JJ and Dale. They're just like yourself. They've been through the corporate world and stuff, but these guys, what they do is they have a list of DSCR lenders, and basically it's very streamlined. You just go in there, you put in, hey, I'm me. This is the property address. This is my credit score. I want it loan to value. I want this request, and you can rack and stack how you want it, like fastest approval or like best rates or whatever you want. They go ahead and clean it up and they fire it out to like 75 different lenders, and it comes back with like 25 offers. I get offers from
Oh,
like
wow.
8.25% interest rate all the way up to like 6.3, but there's always like some caveats. There's like 5, 4, 3, 2, 1 payment penalties. Sometimes there's arms in there, sometimes it's fixed. You can request that, but it fires out all the options. And when you said 5.5, like honestly, I think you'd be at the top of the list on most of their send outs. So it might be a good idea to connect with them. They can put you on the list, and you might get some requests for some loans. But I know that's not like what you guys are really doing, but it is of the loan part that might be beneficial. But
I appreciate that, Richard. So I get this question. A lot of people are like, "Well, can I use that in other markets?" I'm like, "No, I'm not buying down the rate for you to go buy in some other market."
oh
But
yeah, yeah, yeah.
but that might not be. I mean, I wrote their names down. Thank you for that. That's a good. See, I'm learning something today too. So thank you for sharing, Richard.
So
Um,
I met them on Bigger Pockets, and uh yeah, I was skeptical at first, but I've closed down on the deal with them, and it's been easy. Like I haven't really had to do much. It's pretty nice.
That's fantastic. Yeah, I'll engage in the conversation with them, just to see if they have anybody that is looking to buy in Alabama. They buy through us, we can get them the 5.5 through our lender.
Okay.
Yep,
Yeah, but I would like to connect with you, maybe get your information, like your email or whatever the case, and put you in my back pocket for the next deal.
future. So that sounds
But yeah, right now I got 3 properties. I'll be closing on this fourth one. So I got one in Arizona, Yuma, Arizona. I got one in Jacksonville. I got 2 of them in Jacksonville, North Carolina. And the 2 are single family homes, and one's a townhouse. The Columbus, Ohio one is my first multifamily. It's a duplex. I was hesitant about getting into multifamily. I've heard horror stories, but like I said, I was like, you know what? I'm not going to learn unless I just jump in. So, my dream is to get a commercial loan and own like a 20 unit apartment complex one day, and grow from there. But I utilize the velocity banking strategy. So I just buy the properties, I pay them down, get equity. There was that big boom in growth as you guys were talking about. And, I got like a lot of equity in these properties. And what I did, I just pulled out a HELOC, and then I utilize that with the velocity banking. And, once I get back to the States, I plan on doing the IBC, utilizing that as another tool. But yeah, the one in the townhouse, I'll more than likely have it paid off soon. I only owe like 75K. So I'm going to pay that off, and then I'll get a really nice HELOC on that one. And then I'll have a lot of available funds. And I could see myself like closing out on like 2 of your deals at the same time, honestly, and just rapidly growing. My wife doesn't want anything. She hates it that I'm doing this. So, but she does. So she just realized I don't need her signature anymore, and there's nothing she can do about it. So uh, yeah, but in the beginning
that's
it was
funny.
conventional, and I had to get her to sign and the state laws and yada yada yada. But now it's like DSCR, fire,
DSCR.
DSCR, fire, fire, fire. And now so she gets jealous about it. She'd be like, "Who are you talking to?" And I'll be like, "It's Jake from State Farm." Like, you really want to see? Because I'm always on the phone, but I'm talking to like Dale, about rates or something. But
Right.
but,
Oh
but
my
she's
God.
yeah, so I gotta rub her back and be like, I love you. I do love you, but I gotta get back to this. So
Oh, well,
yeah,
I thank you for all that background. That's really cool. I just applaud you for actually taking action. I've talked to so many people, and I'm sure Austin has in the past, over my 20-year career. I have people that will call me up 5 years later, still haven't done anything. I'm like, I'm still
yeah.
thinking about it.
No, I don't, I've seen like a lot of people just this is gonna sound dark, but they just die. You know what I mean? Randomly, they die, whether it be an accident, suicide, whatever the case. But it's just you when that happens to you so many times, you start realizing like, who cares? Like, I don't care if I fail. You know, like it is what it is. Like, life's too short. You know, so that's when I don't say I don't care, but I take calculated risks a lot more so
Mhm.
now. You know.
I
Ties
wish
into your
more,
background too. But
yeah.
yeah, Richard has some cool stuff that he's doing with his company, Twin Trees, as well too. So when you guys chat, have that conversation. Pretty cool background. Richard, I'll make sure to drop all of her contact info when I send out the episode to everyone. So we'll make sure that you guys are connected. Really quick, I feel like this is a value add before I jump in, Maureen.
Yep.
There's this story that's going around. You could almost replicate this story across different scenarios, and this ties into the one property that is a pain in my ass, but this is a story, right? So a city becomes popular. Let's call it Huntsville. Let's call it Kansas City. Let's call it Austin. And then like there's this urban sprawl that happens. That same story applied to that property I was telling you about in Austin. So it's about an hour away. It's in Temple, Texas, and that property is now 20K, 30K underwater. But when I bought it, I thought it was going to be in this quote unquote path of progress and everything. So, what are some trends that you're seeing in Huntsville and some of these surrounding markets that makes you feel that that is not going to be the case? A similar story happened in Kansas City. Wichita is, one of those surrounding towns, and it's doing extremely well. So, same story, but different outcome. What about Huntsville and some of those more popular areas is leading you to believe that it will be the latter and not a story similar to Austin?
Excellent question. Yeah, and I think it's I'm thinking of some data points that I looked at not too long ago, but not real recent. So there was a time where the capital appreciation in Huntsville was double digit. I mean, I'm talking probably 2019 to 2022, 2023 in there. It was just, I mean, up in the mid 20s. Like it rocketed, right? And so that's not sustainable over time, right? It's still growing, but now it's single digit, more moderated, more in line with how the overall market should be. I do think that with the amount of population growth that's happening in Huntsville and I don't know about the market that in the Austin market that you were talking about, but there is still an abundant amount of job growth. For example, one Redstone Arsenal is the largest employer in Huntsville, over 50,000 on payroll. That's all government related. Right near it is the largest research industrial park in the it's the second largest in the US. It's the fourth largest in the world. It's called the Cummings Research Center. You have companies like Lockheed Martin, Teledyne, Airbus, Northrop Grumman, think about all government contracts, right? Ammunitions, rockets, things are being produced there. The Trump administration, they relocated the US Space Command Center from Colorado to Redstone Arsenal. That's going to take 3 to 5 years to build out. The FBI is relocating to Huntsville. And so Toyota Mazda opened up a brand new manufacturing plant about 2 years ago. It was a $1.6 billion plant. I mean, I could go on and on and on, right? And so there is such a plethora of jobs to be had now and in the very foreseeable future that what I see happening is a lot more people, like I said, trying to live in Huntsville proper. Everybody wants to be in Madison. Madison is the best county, it has the best schools, but there's only so much capacity. So then where do they go? Outside markets, which is where I think the real opportunity is. So to answer your question, because I don't know, honestly, like,
Yeah.
you know, because I would have probably thought the same thing with that property that you invested in. It's in the path of progress. I'm going to see great capital appreciation, and then it's overbuilt when, or the rates go too high and people stop buying, and now the rates come, or the prices come down as people are negotiating, right? That could happen anytime in any market. I think where you position yourself is in not necessarily a Huntsville proper, but something on the outskirts. Is that what you did? Was that property on the outskirts of Austin?
It was about an hour away in a town called Belton.
Okay, Belton. And so I would see that happening maybe to like, so we sold them out now, but just north of Huntsville, about 20 minutes, is two new markets. One's called New Market, the other one's called Meridianville, right? Now it's, even though it's 20 minutes from downtown Huntsville, it's still out there because it's in between Huntsville and the Tennessee border, right? And so there's really not much in between there yet. Will it sprawl and go up that way? Most likely, but most people don't know about it yet. So we're not really seeing a lot of, strong capital appreciation in there yet, even though they're brand new homes, which you usually see that year after year. Will that change in a few years? I believe so. But I think what's nice to know about a market like Alabama, it's not an Arizona or a Florida where you're going to get these double digit, well, I should say double digit. You get what's it called? Volatile, right? You've got volatile capital appreciation, which means we all love it when it goes up. We're like, yeah, we're up 40%. It's amazing, right? But it also can go back down the same way with the same velocity. The markets, probably like Columbus, Ohio, the markets that I'm in, it's that slow little train, not that good, right? Just chugging along, 3 to 4 to 5% year after year. Doesn't have a lot of volatility. If you're looking for something more safe, then I would recommend that. I don't know if I
Awesome.
answered your question, but
No, that was great. Just if I could gently persuade everyone in here, make sure you have those conversations with both the turnkey provider and get plugged in further and talk to the developers in the area too. So you can learn the story, because I probably would not have bought in that Texas area if I was competent and confident on what was going on behind the scenes. So Victor, Steve, Jake, when you're picking out your turnkey market or when you're plugging people into turnkey markets, make sure you're facilitating those conversations to really protect people. Because like I said, this is one property that is just a major pain in my ass, and I want to get it off my books. Thankfully, I found renters that are going to take it for the next 2 to 3 years. But just make sure you're doing your own due diligence and you understand what's going on in the back end, because again, that is a mistake that I made. Hey, we got 15 minutes. So I'm going to transition really quick, and I'm going to talk about my true passion, which I never thought I'd be saying this, is life insurance, but using it a very specific way as an asset to go buy other assets. So we're going to walk through a true case study. We're going to walk through my exact numbers on how you could combine this strategy whole life with turnkey real estate. Again, this is my bread and butter. This is what I do. Long story short, I used to do about one property per year when I was just using my high yield savings accounts and bonds. And now I'm closer to 4 to 5 properties per year just by changing the way I stored capital. So we're going to go through a live case study using me as an example for this. So if someone could just give me a thumbs up or Yelp once you can see the screen, and I will go through my policy. Sweet. So this is, no kidding, my first policy. And what you're looking at right here is a whole life insurance policy. There's many different types, but this is a whole life policy. Important to note that. With the whole life policy, there's really 2 main columns that you need to be tracking. On the left-hand side, we have guaranteed, and then on the right-hand side, you see non-guaranteed. The first 2 columns, very self-explanatory. That's my age and then the year of the given policy. The first column is the contract premium. That is how much capital that you're putting in there per year. You'll note there that that first year is bigger than all the other ones. That's because you're allowed a one-time lump sum to actually fund these policies. So what I did personally with my numbers, we got a lot of military people in the chat. I took some contribution dollars from my Roth IRA and my TSP, government 401k, and that's what I used as my one-time lump sum to actually fund these things. So being crystal clear here, my tax bill for that move was $0 because I did a rollover and took some contribution dollars. So instead of waiting for that capital to hit when I'm 59, 65, it's working for me now. So that's what I did for my one-time lump sum. And then the money that I was routing towards a high yield savings account, I started to capture inside of these policies. And note here, your numbers could be different. I have clients that put in $200 a month. I know people that put in $20,000 a month. It's all dependent on what you're trying to do and when you are trying to get there. The next column here is the guaranteed cash value. So crystal clear, this is the essentially worst case scenario value that you will have access to inside your policy. And you could use that to go buy assets. So you have a contract with the life insurance company and you are guaranteed a rate of return. So you could point your finger on this contract and say at 36, I will have X amount of money in my policy. There are certainties and guarantees baked into this thing. And also because you have a life insurance contract, you are also guaranteed a death benefit that is paid upon your death or whoever the insured is. I don't plan on dying on anytime soon. I'm sure you don't either, but I'm sure you know someone with cancer. So life could get real very, very quickly, and you could access a portion of that death benefit early if something were to happen to you. But that's really not really why I'm using it or why I care about the death benefit. If you guys know me and my story, what I'm doing is I'm taking my death benefits and putting them inside of a trust. I control the rules and regulations around that trust, which are helping with some of my philanthropic goals in both the martial arts space and then the disabled community space too. So, peeling back the layers a little bit, like truly, I feel like we are at a time and place where corporations and governments are not going to save us. Newsflash, right? But people are going to save people. You could structure your capital to help fund some of those passions that you have or protect your family. And truly, I feel like we are at a time and place in history where people are going to have to step up to the plate and start doing this. And that is the mission behind everything that I'm doing, is that method. And to encapsulate that, that is called the Rockefeller method. So that is the guaranteed side. Jumping over to the non-guaranteed side, the main talking point here is dividends. It's very important to note that dividends are not guaranteed, but in a big but, they've been paid on time with very little variance for the past 2 centuries. A couple of little fun facts I threw out here is life insurance companies have been around longer than banks. They predate the tax code, and banks are the largest owners of whole life insurance, which blew my mind. But if you look at what a bank does, they are in the business of lending money to make money. If you can lend money and a portion of your portion of your return is guaranteed, that's very advantageous. So that is why banks own so much. And then the next column here is the net cash value. And all that is the cash value when those dividends are reinvested inside of the policy. So you guys all know how compounded interest works, but just to highlight the power here, if we go down to my age 62, we have $1.6 million versus $3.6 million in cash value that you would have access to inside your policy. And then finally, we have our death benefit, which is just the death benefit with the incorporation of those dividends once they're inside of the policy. I'll pause here and really highlight the fact that this is not a normal whole life policy. And that is where the waters start to get very convoluted inside of the whole life space, our insurance space as a whole. I heard about this concept about 5-6 years ago, immediately wrote it off as a scam. And honestly, it's kind of for good reason too. Life insurance in and of itself is not a scam, but the way it's sold is. And I want to highlight here, what you're looking at is not a normal life insurance product. What is normal, what would be normal, is you would see a zero in this net cash value for the first 1 to 5 years. So if my intent is to go buy assets as quickly as I can, and I can't access my money for the first 1 to 5 years, then no shit, you wouldn't use that design, right? But that's where things get really convoluted, is because that is what's normal. And finance is really similar to politics. Once we get an idea in our head, things tend to get really tribal, and it could be impossible to communicate and communicate different ideas. I know that because it happened to me. It took about 30 books and 1,000 hours of conversations for me to get to this point and actually get through my head. But yeah, I just wanted to highlight that this is not a normal policy that you're looking at. This is a high cash value design with the intent to go buy assets as quickly as you can. And 10 minutes left here. I'll just walk through some numbers of what I did here first year and how you could combine something that Maureen is doing with what I'm doing on the whole life side. And we'll just use my, no shit numbers here. So you'll note there again, first year, I put in 170K and I had access to about 150K. Again, not normal at all. This is very high efficiency. With that 150, I deployed about 120. With that 120, I went to go purchase some cash flow in real estate in the Midwest. Those properties generate cash flow. That cash flow pays off the interest that I pay to the insurance company. But here is the main kicker. When I deployed that 120, I am still gaining interest and dividends tax free at 150. I'm applying leverage. I'm using life insurance company money to go buy that asset while my money remains intact and continues to grow tax free. Walking through that example again, to drive it home, let's go down to policy age 16. We have $1.2 million of cash value. If I extract 600K to go do that 333 deal, I still gain interest and dividends tax free at $1.2 million. Again, I'm using debt, cheap and flexible debt to go buy that asset while your money remains intact and grows tax free. So that is really the cycle that I run there. And comparing that to what I was doing before, like I mentioned, I was just using a high yield savings account and bonds. So before with that, every time I would save up to a down payment, let's say it's 50K, I'd go back down to zero. There is no leverage. There is no, and more on top of that, you're taxed the entire time. So you're like a dog chasing its tail. With this strategy, it allows you to capture those down payments. You capture those down payments and apply leverage and effective tax planning to go buy your assets. And one question that really comes up that I want to hit on is the cost of insurance. And we have to be very clear about that too, right? If I put in 170 and only have access to 150, that's a 20K delta. That's serious. You have to look at that cost of insurance, but you have to be cognizant on what that cost gives you. It gives you protection, a guaranteed rate of return. A lot of things can't guarantee you that. What happens if we invade Iran next week, which could happen, that could tank your stock portfolio. These companies have paid dividends through the Civil War, World War I, and World War II. So having guarantees and protection is very important. Also, death benefit. It's great. It's not really my primary concern, but that death benefit is money that you don't have to save up to in your different government accounts, which is very important when we're talking passions and taking care of the next generation. So that's protection. The retirement benefits. Remember, all the growth inside that policy is tax-free. And there's no red tape like there is with different government accounts. And then finally, you have that leverage benefit too. You have the capability to leverage your money to go buy assets while your money remains intact. So yes, there is a cost of insurance, but when you think long-term, past 3 years, the efficiency just gets blown out of the water. And then with the remaining time, I really want to get slick here and talk about some more advanced moves you could do, combining the world of real estate with these policies. So you could do cash out refis or partial 1031s and use these policies as a net to capture capital and help you scale way quicker. Let's say we have a property with 300K in equity, right? Instead of doing a cash out refi and going straight into the next property, you could take that 300K, use it and capture it inside this policy. So now it's working for you now, and then immediately leverage and go buy that next deal. Some things you have to consider when we're talking reality in the world of real estate. If you're trying to do a cash out refi and go buy that next deal, that equity is not giving you a rate of return, right away, just sitting there. It's inside of that deal. But what happens if you can't cash out refi again? What happens if you can't sell? What happens if you can't 1031? This allows you to capture that capital now, start earning inside the policy while you still go buy that same asset. So you duplicate those dollars. It's working and earning for you now while still being in your next deal. So again, you could get really slick doing cash out refis or partial 1031s and use these things as nets to help scale your real estate portfolio. And the last thing I'll end with is this. This is just one design. This is a very, we'll call it bare bones design. You could implement these with businesses too. And get this, the contract premium could be a tax write-off. So if you're a business, you could lower your tax liability with the money that you're putting in, potentially bring you below and get you back into QBI threshold. So it's another 20% savings on top of that, while you still have all the different whole life benefits that we talked about. So there is some incredible tax plays that you could do both on the individual investor side and on the business side too. So pretty crazy things. But I'll end it with that for any questions. And I'll be very respectful every time. I don't want to go over budget, but that's what I got.
Okay, I've got a couple of questions, Austin.
Yeah.
So the contract premium, that's something you have to remit every year, correct?
Yeah, but you have flexibility too there. So this is the maximum amount that you could put in. My job as someone that designs these is to get you really close to what's called the MEC line. MEC stands for minimally endowed contract. So once you bust that MEC line, you lose all the tax benefits in here. So what you're seeing is the maximum amount that you could put in. But if we scroll down here just a second, you'll see that my maximum amount I could put in, that's what this illustration shows, is $4,100 a month. But the minimum amount just to keep it in force is around $1,900 a month. And
I
then
see.
getting slick too here. So let's say if you didn't want to pay that premium, maybe you're having some good years, bad years, you can enact something called reduce paid up. For this company, it takes an effect after year 7, where you can lower or reduce your death benefit and it will cover the premium and keep your policy in force. So essentially, you could kick this thing to the curb, just have your death benefit cover it while you still reap all the benefits.
Ah, okay. Okay. That's interesting. And then, so I am curious after all your research, because I literally was talking to an investor, I want to say it was last week before the Memorial weekend. And he was like, oh yeah, I think I'm gonna do a whole life insurance policy, but I can't start until 5 years from now. And so I was like, oh, what? Because he was a little bit older. I was like, I don't know, that's the best idea. So
Hmm.
what I've learned from you in this presentation here is that, you know, out of the 170 that you put in year 1, you had access to 150, I guess, soon after and within the same year
Right
of
away.
right away. Okay, so right away. So what makes where is the disconnect between some companies are saying you can't touch it, you can't start for 5 years, and then you're saying you can start immediately?
So I can only make my best guess based on the information that I have, but what I would assume he was talking about is having access to that cash value, which goes back to that initial conversation that I had. Remember, what's normal here is you would have $0 for the first 1 to 5 years. So that may be what he's saying. He may
Yeah.
be saying, I can't touch my capital for the first 1 to 5 years because I'm not building any equity yet. But I am flipping that design on its head. I care about efficiency, which is how much capital you have access to right away. That is this high cash value design niche. So, again, I don't have the depth of
Yeah.
what he was talking about, but that's probably what it was if I were to guess.
Okay. All right. Cool. Thank you.
Is
Yep.
is this a 90-10 split? I didn't do the math. Is it?
This is a 60-40 split. So for Richard, it's pretty in depth in IBC and everything. So 60 PUA versus 40 base. The main thing you got to be tracking here with those base splits is the higher the base, the higher the death benefit, and it's going to be lower cash value. So this is a big debate inside this world, but the gold standard is considered 60-40. You could go up to 90-10, 80-20. You could do those things, but something to be cognizant about. We're getting into the weeds here, but your base premium is based, or your dividends are based on your base premium. So you don't want to go too high on that split, go up to a 90-10 because your dividend will be lower. So where I operate with my clients is 60-40 to 70-30. If they want to go higher, by all means do your thing, but I just want to make sure that you're cognizant that your dividends may be lower, which will hurt you in the long term.
Okay. Is this through Lafayette or Mass Mutual or something?
This is Lafayette. These are my favorite players in the scene. I do most of my business with Lafayette. They are very big players in the scene, and they are very big proponents of actually using these high cash value designs. Um, I won't go too much in depth. I don't want to bust time on you, but yeah, this is a Lafayette policy.
I got one more question. The dividends, so it's like 5%. Was it like 3% annually guaranteed, quote unquote? And
Yeah,
they
so
have like a window, right? Like varies, you can get up to 5% or something like that.
So this is where things again, and people will mislead people in selling these things. This is the stat that you really need to be tracking when we're thinking about these policies in terms of a rate of return view. The average rate of return throughout the entire life cycle of the policy is going to be 3 to 4%. So you're going to get a guaranteed return, which is this left-hand side, and then you're going to get a portion of that death benefit. When you add those two things together, the average rate of return throughout the entire life cycle of the policy is going to be 3 to 4%.
Mm. And then if I got an outstanding balance, right? Like I pull like I don't know, year 15 and you got 1.1 in there and I'm like, "Hey,
Mhm.
I'm just gonna spend it all or whatever." And then, I die at 50. Like it just comes out of my life insurance. It's not going to impact my family or nothing like that. It's just going to come out.
Yeah, just be cognizant that when you die, if you do have outstanding loans, the total death benefit passed on, which by mind you is tax free and probate free, is the death benefit minus outstanding leverage. So that's
Right.
actually a really common technique people will do. They'll take loans for supplemental income, and God forbid I die here at 62, I have $6 million in death benefit. If I had $3 million of outstanding loans, $3 million is still being passed on tax free probate fee to the next generation.
But you gotta be on U.S. soil to enact one of these
Yeah,
policies.
yeah, yeah. That's a kicker. But hey, I
Even
really
though
don't want to
I'm on
bust
a
time.
U.S. base, it's
Yeah,
crazy.
hey, I don't want to bust time on anyone. We'll end it there for the formal portion. If you want to stick around and ask questions, learn more, by all means, but don't want to hold anyone hostage. Maureen, thank you so much. We'll make sure to push out all of your contact info in the episode update. We recorded this time, so that's good. But yeah, thank you so much. And a reminder, guys, a lot of people own businesses in this chat. Plug into Marine, send your clients to Marine, and continue to help build people's wealth building team. So thank you so much, guys. I appreciate you coming. Marine, thanks again, as always,
My
and I appreciate
pleasure.
you.